Ever wondered if there are better places to put your money than just leaving it lying around in your regular savings account? Well, guess what? This video is for you. Today we're going to explore 16 assets that are considered better than cash by none other than Warren Buffett. Let's start by talking about the man himself, Warren Buffett. Known as the Oracle of Omaha, he is one of the most successful investors of all time. Born in 1930, he showed an early knack for numbers and business. He bought his first stock at the tender age of 11 and went on to graduate from Columbia Business School, where he was mentored by the renowned economist and father of value investing, Benjamin Graham. With a net worth of over $100 billion, Buffett is consistently ranked among the world's wealthiest people. Despite his wealth, he's known for his frugal lifestyle and his commitment to philanthropy. He has pledged to give away 99% of his fortune to philanthropic causes. But what truly sets Buffett apart is his investments. Buffett is a big believer in diversifying assets, and it's a key component of Buffett's investment strategy. He once said, "Do not put all eggs in one basket." So why is diversification so important? Well, diversification is a risk management strategy that involves spreading investments around. By owning a range of assets, you can protect yourself from unexpected changes in the market. When one of the assets isn't doing so well, don't worry, because the others can step up and make up for it by doing really well. Buffett believes that diversification can help investors reach long-range financial goals while minimizing risk. However, he also warns against excessive diversification, or what he calls diversification. According to him, it's better to invest in a few businesses that you understand well than in many businesses you know little about. Now let's get to the heart of today's video. Here are the top 16 assets that Warren Buffett believes are better than cash. Let's go through each one, discussing what they are and why Buffett recommends them. Well, let's start off the list. At number 1, we have stocks.
Stocks are safe for the long run, and they're very unsafe for tomorrow. Berkshire, 3 times since I took over, has gone down roughly 50%. Did I feel poor then? No, not at all. I knew it was going to be worth more over time. American business is going to be worth more over time. That's what you're buying as a business. You're not buying a stock. You're buying a piece of a whole bunch of businesses. Are those businesses going to be worth more 10 or 20 or 30 years from now? Of course they are. But if you think you can jump in and out, or that you know the time to come in, I think you're making a mistake.
Imagine owning a piece of a company you love. That's what stocks are all about. You buy shares in a company and become a part owner. Buffett is a big fan of buying and holding stocks of companies he believes in. He looks for companies with strong fundamentals and good management. He's not interested in short-term price fluctuations. Instead, he focuses on the long-term potential of the company. He believes that if a business does well, the stock eventually follows. Coming in at number 2, we have bonds. Bonds are like IOUs. When you buy a bond, you're essentially lending money to the issuer in exchange for periodic interest payments and the return of the bond's face value when it matures. They're considered safer than stocks, and Buffett often uses them to balance his portfolio. He looks for bonds that offer good interest rates and are issued by reliable institutions. At number 3, we're looking at real estate.
That's one reason real estate in general is good during inflation. If you built your own house 55 years ago like Charlie did, or bought one 55 years ago like I did, it's a one-time outlay. Whereas if you get an inflationary expansion in replacement capital without having to replace yourself.
Estate investing can be as simple as buying a rental property. It's all about location, location, location. Buffett has made indirect real estate investments through stocks like Store Capital. He believes that real estate can be a good investment if you know what you're doing. It requires careful research and management, but it can provide a steady income stream and potential appreciation. Taking the 4th spot on the list, we have mutual funds. Well, mutual funds pool money from many investors to invest in a diversified portfolio of assets. They're managed by professionals and are a great way for beginners to get started in investing. Buffett often recommends low-cost index funds for average investors. He believes that they offer good diversification and can match the market's performance over the long term. At number 5, we have ETFs. Exchange-traded funds, ETFs, are like mutual funds' cool cousin. They offer diversification and are traded on exchanges like individual stocks. ETFs can track everything from the S&P 500 to specific sectors or foreign markets. Buffett likes ETFs because they offer broad diversification and have lower fees than actively managed funds. Coming in on number 6, we have REITs. Imagine owning a piece of prime real estate, collecting rent, and not having to worry about managing the property. That's what real estate investment trusts, REITs, offer. They are companies that own, operate, or finance income-generating real estate. You can buy shares of a REIT just like you would buy stocks of a company. They offer the benefits of real estate investment without the need for direct property ownership. The number 7 brings us to commodities. Ever thought about owning gold or oil? That's what investing in commodities is all about. Commodities are basic goods used in trade that are easily exchangeable with similar items of their kind. While Buffett has traditionally avoided commodities because they don't produce cash flow, he has invested in gold indirectly through stocks. He sees gold as a speculative investment that doesn't produce anything, but he acknowledges that investors turn to it during times of fear. At halfway through the list, at number 8, we're keeping it safe with Treasury inflation-protected securities. Treasury inflation-protected securities, TIPS, are a type of U.S. government bond specifically designed to help investors guard against inflation. The principal value of TIPS adjusts with changes in the Consumer Price Index, CPI, a widely used measure of inflation. When inflation rises, the principal value of TIPS increases. Conversely, it decreases with deflation. As interest payments on TIPS are fixed, the dollar amount of interest paid is affected by the adjusted principal. So, when the principal increases with inflation, the interest payment rises, and when it decreases with deflation, the interest payment falls. At maturity, investors receive either the original or inflation-adjusted principal, whichever is higher. This ensures that the purchasing power of the invested money is preserved, making TIPS a popular choice for those concerned about inflation eroding the real value of their investments. Well, moving into the entrepreneurial world at number 9 with private businesses. Investing in private businesses can be a lucrative move if the business succeeds. Buffett has invested in several private companies throughout his career, and some of his most successful investments have been in private businesses. But remember, investing in private businesses can be risky and requires thorough research. Moving on, the number 10 gives us collectibles. Got an eye for rare stamps or coins? Collectibles can sometimes appreciate in value over time. Collectibles are unique items that are worth more than they appear because of their rarity or demand. While Buffett doesn't invest heavily in collectibles, he doesn't rule them out either. Coming in at number 11, we have cryptocurrencies. Cryptocurrencies have been creating quite a buzz in the financial world. The most well-known is Bitcoin, but there are thousands of others including Ethereum, Ripple, and Litecoin. While Buffett himself has been skeptical about cryptocurrencies due to their extreme volatility and lack of regulation, some investors find them appealing for their potential for high returns. But remember, with high reward comes high risk. Now at number 12, we have timber and farmland. Timber and farmland represent unique asset classes that provide both tangible and financial benefits. Timberland, consisting of forests intended for logging, offers a renewable source of revenue, as trees are harvested and sold for lumber and related products. Its value often grows over time as trees mature, and in some cases, timberland can act as a natural hedge against inflation. Farmland, on the other hand, comprises arable lands used for agricultural production, such as crops or livestock. It has the potential to generate consistent income from the sale of produce or lease agreements with farmers. Both timber and farmland offer diversification opportunities for investors, as their returns typically exhibit low correlation with traditional assets like stocks or bonds. Additionally, they can serve as a hedge against inflation and provide environmental or ecological benefits. At number 13, we have derivatives. Derivatives might sound complex, but they're just financial contracts whose value is derived from underlying assets like stocks, bonds, commodities, currencies, interest rates, or market indexes. Buffett has warned about the potential dangers of derivatives, calling them financial weapons of mass destruction, but he has also used them in his investment strategies. Coming in at number 14, we're looking at the VIP of stocks, preferred stocks. They give you a higher claim on earnings and assets than common stocks. This means if a company goes bankrupt, preferred shareholders get paid before common shareholders. Plus, preferred stocks usually come with a fixed dividend, which can make them attractive to income-focused investors. Buffett has used preferred stocks in several deals to achieve specific investment objectives, down to the final two.
As a general matter, there are only two reasons for buying insurance. One is to protect yourself against a loss that you are unable or unwilling to bear yourself. The second reason, which occasionally comes up, is if you think the insurance company is actually selling you a policy that's too cheap, so that you really expect to, over a period of time, to have a mathematical advantage by buying the insurance. Well, we try to avoid selling the second kind and to concentrate on selling the first kind. And we think any company we sell insurance to, and of course much of the insurance we sell is to other insurance companies. I mean, we are a reinsurer in very large part.
At number 15, we have insurance policies. Some insurance policies can be considered an investment if they build cash value over time. Whole life insurance policies, for example, combine a death benefit with a cash value component that can grow over time. An interesting fact here is that Buffett's first business was actually selling insurance, and today one of Berkshire Hathaway's major operations is the insurance and reinsurance business. And finally, at number 16, we have annuities. Annuities are contracts with insurance companies designed to help secure your financial future. In exchange for an upfront premium, these contracts provide regular income payments for a certain period of time, or for the rest of your life, making them a popular choice for retirement planning. While annuities aren't a core part of Buffett's investment strategy, they can be a good fit for certain investors. Well, that wraps up our list of top 16 assets that Warren Buffett considers better than cash. Each asset has its own set of advantages and potential risks. And by understanding these assets better, you can definitely make more informed decisions about where to put your money. So, you're probably wondering, how can I start investing in these assets? Don't worry, we've got you covered. First up, get to know your asset. It's like making a new friend. Understand what it is and how it works. Next, set your sights on your financial goals. It's like planning a road trip. Know your destination. Then, gauge your risk tolerance. It's like choosing a hiking trail. Understand what you're comfortable with. Lastly, it's an important one. Diversify your portfolio. It's like a balanced diet. A variety of assets can help ensure a healthy investment portfolio. We hope this video has given you some food for thought about your own investment strategies. Remember, the key to successful investing is research and diversification. If you found this video helpful, please give it a thumbs up and share it with your friends. Make sure you hit that subscribe button and turn on notifications so you don't miss out on our next videos. And as always, thanks for watching.